Booyah! Today we're diving into the exciting world of options trading with the short strangle strategy. Don't let the name scare you, it's simpler than it sounds. In a nutshell, we're selling both a call option and a put option of the same expiry date, but at different strike prices. The key here is that both options are out of the money, meaning we're betting the underlying asset, in this case the Nifty 50, stays within a certain range. Remember, selling options is like being the insurance company. You collect premiums upfront, but you're on the hook if things go south. So why take the risk? Well, if the Nifty 50 trades sideways or with low volatility, those options expire worthless, and you get to keep the entire premium. That's right, pure profit. But hold your horses. This strategy isn't for the faint of heart. If the market decides to make a big move, you could be facing unlimited losses. That's why it's crucial to understand when to apply this strategy and how to manage those risks. Stick with me, and I'll break it all down for you. Before jumping headfirst into a short strangle, we need to assess the market temperature. Right now, the Nifty 50 is sitting pretty at 19,500. Analysts are whispering about a potential range between 19,000 and 20,000 for the coming month. That's a range of 1,000 points, which seems wide enough for our strategy. But wait, there's more! We can't forget about the VIX, the market's fear gauge. A low VIX indicates low volatility, which is music to our ears. When the VIX is subdued, it means traders are expecting calmer waters, making it a prime time to sell options. Think of it like this. When the sea is calm, you're more likely to sell someone insurance for their boat. But when a storm is brewing and the VIX is surging, you better batten down the hatches and steer clear of selling options. Alright, let's get down to brass tacks and build our short strangle. Remember, we need to sell both a call and a put option with the same expiry date, but different strike prices. Since we're expecting the Nifty 50 to stay between 19,000 and 20,000, let's pick strike prices outside this range. For our call option, we could sell the 20,100 strike, and for the put option, we could sell the 18,900 strike. Both of these strikes are 100 points away from our expected range, giving us some breathing room. Now, the premium you collect for selling these options will depend on various factors like time to expiry, implied volatility, and interest rates. But remember, the higher the premium, the riskier the trade. It's always a trade-off. Section 4. Managing risk like a pro. Now let's talk risk management. Selling naked options can be like playing with fire if you're not careful. One way to manage risk is by setting stop-loss orders. This means automatically buying back the options if the market moves against you beyond a certain point. Another strategy is to implement a covered strangle. This involves holding a long position in the underlying asset, which can help offset potential losses from the short options. Think of it like having insurance for your insurance company. Remember, managing risk is all about protecting your downside. It's like wearing a helmet while riding a bike. You might not need it, but you'll be thankful you have it if you take a tumble. Section 5. Rewards, risks, and market factors. So what's in it for you? Well, the maximum reward for a short strangle is the net premium you receive when selling the options. If the Nifty 50 stays within our expected range, those options expire worthless, and you get to keep the whole pot of gold. However, the risk is theoretically unlimited if the market makes a significant move against you. That's why it's crucial to choose your strike prices wisely, manage your risk diligently, and monitor the market like a hawk. Keep in mind that market volatility, time to expiry, interest rates, and economic events can all impact your strangle's performance. A sudden spike in volatility or an unexpected interest rate hike could throw your strategy off course. That's why it's important to stay informed, adjust your strategy as needed, and never invest more than you can afford to lose. Remember, in the world of trading, knowledge is power, and risk management is king.